Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of Aditya Birla Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Vishakha Mulye, CEO, Aditya Birla Capital. Thank you, and over to you, ma'am.
Thank you. Good evening and welcome to the earnings call for Aditya Birla Capital for the quarter ended June 30th, 2022. I'm pleased to present the business performance and the financial results for Q1 FY23, and I'm joined by my senior members of the team. Together we will present the results and take any questions you might have. I've taken office as the Chief Executive Officer of Aditya Birla Capital Limited with effect from 1st July 2022. I'm delighted to be a part of ABCL, a company that is uniquely positioned to capitalize on the opportunities in the financial services sector in India. Before coming to our performance this quarter, I would like to mention that the Indian economy has started on a good note in Q1 FY23. This has led by a recovery in the demand to a pre-pandemic level, which in turn has driven industrial activity and service sector. This is reflected in the service sector PMI at 59.2 and a GST collections at an all-time high of 1.44 trillion in June 2022. However, the overall macroeconomic environment has seen headwinds emerge over the past few months, led by inflationary pressures and a slowdown in the global economy. Though continued concerns remain due to these headwinds, for FY23, the Indian economy is expected to grow at about 7%, driven by the domestic demand. This growth rate would put India as the fastest growing economy in the world. This will create great opportunities in the Indian market. We at ABC believe that we are well positioned to leverage on these opportunities. Now, I'm pleased to report that Aditya Birla Capital has delivered a strong quarter with a 429 crores of consolidated profit after tax, a 42% year-on-year increase driven by the growth across our platform. Let me quickly summarize the three highlights of our performance this quarter. In our lending businesses, the overall loan book grew at 22% year-on-year to close at about 70,000 crores. The insurance business gross written premium grew by 53% year-on-year to reach 3,250 crores. With 3.6 lakh crores of aggregate assets under management across our platform, we are one of the largest fund managers in the country today. Our active customer base has now reached 39 million customers, reflecting a significant 55% year-on-year growth. I'm also happy to state that with this performance, we are on track to deliver ahead of our previously stated FY24 targets. Our customers are focused on customer acquisition, retailization of portfolio, new products, our customer segments as well as greater penetration in existing customers to enhance our market share by leveraging technology and data analytics has enabled us to deliver both growth and greater profitability across our platform. We have added about 4 million active customers in this quarter. Though our continued and sharp focus on customer acquisition, both through our expansion in our branch network and our digital ecosystem strategy. Our physical footprint has now reached almost 1,100 branches, driving our presence in every town in India with a population of at least 3 lakhs. Our branch expansion is targeted at driving penetration into Tier 3 and Tier 4 locations and new customer segments. In addition, we have continued to drive our common One ABC branch rollout with over 113 co-located branches now operational. In addition to expanding our physical footprint, we have also added new and customized products to augment our product suite. To give a few examples, in this quarter we launched a co-branded credit card with SBI cards in our lending business, a fixed maturity product in our life insurance business, and OPD product in our health insurance business. We will continue to drive new product additions to serve the needs of our existing customers as we expand our target customer segments. We continued our focus on providing better customer experience through seamless customer journeys, onboarding, and personalized solutions through digital offerings. For example, over 96% of our customers were onboarded digitally. This quarter, we had over 10 million customer interactions on a digital channel, and 87% of our insurance policies were renewed digitally. We leverage our analytics capabilities to increase the share of our wallet with our customers. In this quarter, 35% of our life insurance individual FYP and 20% of our health insurance retail fresh premium was driven by data analytics-led upsell and cross-sell initiatives. Let me now give you a brief summary of our business-wide performance. Let me start with our NBFC business. The outstanding loan book as on 30th June 2022 has increased by 26% year-on-year and 5% quarter-on-quarter. Within that, the retail and SME loans grew by 39%. Retail and SME constitute now 64% of our loans as on 30th June 2022, as against 56% a year ago. The improved mix has driven NIM expansion by 33 basis points year-on-year to about 6.5% this quarter. The quarterly PAT for ABFL has increased by 43% year-on-year to 335 crores, and ROA has increased by 46 basis points to 2.5% from 2% as on 30th June 2021. In the housing finance business, we continued our focus on the affordable housing segment. The outstanding affordable loan as on June 30th, 2022 grew 45% year-on-year. The NIM expanded by 59 basis points year-on-year to about 4.6%. The PAT has increased by 45% year-on-year to 56 crores. ROA for us as on June 30th, 2022 was at 1.9%. Now let's talk about our mutual fund business. The average AUM in our AMC business has grown by 2% year-on-year. However, within that, our equity AUM has grown by 14% during the same period. The overall equity mix has grown from 37% to 41% as on June 30th, 2022. Despite the challenging market, this business has maintained its operating PBT at 172 crores. However, the market volatility and the interest rate environment has impacted the overall profitability for this business. Taking into consideration the mark-to-market impact, the PAT for this business was 103 crores for Q1 FY23. The growth momentum in our life insurance business continues with 26% year-on-year growth in retail first year premium and about 2x growth in our group businesses. The total premium in our business grew 49% year-on-year to reach over 2,600 crores. We also continue to see the profitability profile of this business improving, and we are well on track to deliver the 17 to 18% net VNB margin this fiscal year. In our health insurance business, our unique and differentiated model helped us to deliver industry-leading growth of over 70% this quarter on a year-on-year basis. ABHI was the fastest growing health insurance player in Q1 FY 2023. With an increase in the market share of about 300 basis points, our overall market share is now 12%. I will now talk about our key focus areas going forward. One, we intend to leverage the momentum we have seen across our businesses to accelerate our growth trajectory and continue to build scale and drive market share in each of our key businesses. We will continue to focus on quality and profitable growth. Number two, continue our retailization strategy by driving customer acquisition by building our direct channel, partner ecosystem, as well as by increasing penetration into new markets and customer segments. Our branch expansion will be primarily driven by increasing the footprint of our lending and health insurance branch network, as well as the co-located one ABC branches. Number 3, drive steady increase in digital adoption across our platform. Investing in leading edge technology, analytics, and digitization is central to our approach. We will focus on integrating and adopting new technologies to improve our customer experience and new customer acquisition. Number 4, focus on extended ABG and ABCL ecosystem to accelerate our growth. We will focus on building specific and unique propositions, including products and customer journeys for stakeholders within these ecosystems, such as suppliers, distributors, and employees. With that, I will now hand over the call over to Rakesh to take us through our lending business performance.
Thanks, Vishakha, and good evening, everyone. I will now walk you through the performance of our lending businesses, starting with NBFC and then housing. In our NBFC business, we had a strong start to the financial year. Our loan book grew 5% quarter-on-quarter and 26% year-on-year to 57,839 crores, with our NIMs reaching another all-time high of 6.5%. This was also aided by strong growth in our retail segment book, which grew 80% year-on-year and 15% quarter-on-quarter to 20,249 crores. Quarter 1 PAT grew 43% year-on-year and 14% quarter-on-quarter, delivering an ROA of 2.5%. This takes our ROE to 14.3% this quarter, which is an increase of 300 basis points year-on-year and 127 basis points quarter-on-quarter. Not only are we going strong on profit delivery, we are also continuing to acquire customers at scale. With 1.4 million customers acquired in quarter 1, our active customer base has grown 32% quarter-on-quarter to 4.8 million. We disbursed rupees 8,039 crores in quarter 1, 3 times of what we did in last year quarter 1. 73% of our disbursement was in retail and SME segment, which now comprise 64% of our overall loan portfolio. And we are already at our desired mix as per our guidance provided earlier. In retail, we continue to drive granular growth with portfolio average ticket size reducing from 4 lakhs last year to 40,000 in quarter 1. Our digital ecosystem strategy continues to fuel growth with 47% of retail disbursements coming from digital ecosystem in quarter 1. We focus on leveraging data analytics to leverage cross-sell opportunity on the large customer base we acquire. And we saw nearly 20% growth in our digital portfolio come from cross-sell of personal loans on the customer base acquired through the digital ecosystem. Further, on asset quality, our gross stage 3 book is maintained at 3.2%, while our stage 2 book has reduced over previous quarter. Our collection efficiency is at a 99.3%, consistently better than the pre-COVID levels. We have progressively increased our stage 3 PCR, our provision coverage ratio, taking it to healthy 48% in quarter 1. And I also want to highlight that 73% of our portfolio is secure in nature. As of quarter 1 end, we have only 500 crores of the initial restructured book which is under moratorium, which is only 0.85% of the overall portfolio. On rest of the restructured book, we are witnessing a healthy collection efficiency similar to last quarter. With that, let me spend a couple of minutes on key developments in our growth strategy. We continue to focus on 4 essential pillars. 1, retail portfolio expansion with increased granularization. 2, specific industry focus and digital platforms to drive SME and B2B segment. 3, acquiring customers at scale using digital ecosystem and data analytics. And 4, increasing direct sourcing through our branch expansion in tier 3 and 4 markets. And I have strong outcomes to share in each one of these areas. Starting with retail, This segment grew 80% year-on-year and 15% quarter-on-quarter to 20,249 crores. And in terms of mix, is at 35% of the overall portfolio as of June 22, an improvement of 10% over last year. More so, the contribution from new products such as small ticket loans and digital ecosystems grew nearly 4x in the last 2 years. These products make up 32% of the overall retail segment, and this mix has increased from 15% in Q1 last year. Similarly, in SME segment, we focus on specific industries, deepening penetration and leveraging digital MSME platforms to source from across the value chain. The SME business distribution footprint is now live in 25% of ABFL's branch footprint as of Q1 this year, targeting SME clusters in chosen industry sectors. When it comes to investment in technology, we have two-pronged approach. We consistently look at enhancing our platform to onboard and underwrite customers faster, and we have shared few key outcomes demonstrating strength of our technology capabilities, especially in three areas: customer acquisition, servicing, and process automation. Lastly, expanding share of direct sourcing is key to our retail strategy. We increased our branch count to 191 as of June 22 from 159 in March 22. We have also increased our sourcing from direct and digital ecosystem channels to 51% as compared to 21% 2 years ago. And our plan is to increase this further. While we grow our branch footprint, we have been successful in maintaining our cost-income ratios at similar levels as of last quarter. Our financial numbers highlight our commitment to our strategy, and we are well equipped to deliver strong growth momentum in FY23. We set out our growth aspiration for FY23 in the last quarter, and we are confident of delivering an overall loan book growth of 20% in this financial year. With our small ticket and digital ecosystems firing at scale, where we expect more than 2x growth by year end. With our current growth trajectory and continued focus on key segments, our ROE should comfortably reach the guided range of 16 to 17% ahead of time. Now I will shift to housing finance business. Coming to housing finance business, we had stated earlier that growth in affordable book is expected to drive superior returns. We have seen growth in disbursements in our target segment in the housing finance business as well. Q1 disbursements were up by 170% over the Q1 last year. Of this, the affordable segment disbursement mix was almost 50%. This has taken the affordable portfolio mix to 39% from 29% in the previous year. The shift in the segment mix, supported by the lower cost of borrowing, has helped the organization to report the highest ever NIM of 4.59%, an increase of 59 basis points over the last year. Not only have our margins expanded, but our customer selection and calibrated underwriting strategy has helped risk-adjusted returns, which is defined as NIM less credit costs, to expand by 120 bps over the previous year. With improvement in margin, housing finance PAT for quarter was up 45% year-on-year, taking our ROA to 1.9% and ROE to 13.7%. Efficient collection management of 97.9% has led to a lower credit cost of 52 basis points compared to 1.14% last year. Only 3% of our portfolio is under moratoria, most of which is due for banking in Q2. We have created sufficient management overlay across all stages. We also have very comfortable ALM, and our capital adequacy is at very healthy 23.8%. Growing our affordable book continues to be our focus, and to drive affordable penetration further, we have expanded our branch count to 121 branches, with 76 percent of these branches are in tier 3 and 4 markets. We target to increase our branch footprint to 200 plus by end of this financial year. We have also augmented our frontline capacity to drive affordable volumes and create additional distribution capacity. Direct sourcing is already healthy at 72% in quarter 1 of this year, and this really ensures higher customer stickiness. Our progress in digital capability gives us the confidence of scaling up ecosystem partnerships and co-lending as an alternate sourcing channel. On the technology front, we have made some good progress. Majority of our customers are onboarded digitally. Overall, 92% of our customers are onboarded digitally. On service front, we have enabled multi-channel servicing, which includes WhatsApp, eBot, Google Assistant, and self-serve portals. This has led to 77% of our customer interactions coming from digital channels, and over 98% of our housing collections are through digital means. With this, I would like to sum up the housing finance business. A structured shift in our business mix, wider geographical footprint, and increased distribution capacity, we expect to see 20% growth in portfolio and steady margins. We have already surpassed NIM and ROA targeted for FY24, and the focus is now on growth as the operating leverage will now improve these metrics further. With this, I will pass it on to Birla for our asset management business.
Thanks, Rakesh, and good evening to everyone. As I presented the AMC analyst call, give a quick overview on AMC performance. Our total quarterly average assets under management for the quarter ending June 2022 stood at 2,97,000 crores with an annual growth of about 2%, continuing to maintain our leadership position in the industry. Our equity mutual fund AUM grew by 14% year-on-year to touch 1,79,000 crores for the quarter ending June 2022. In fact, our equity asset mix now at an all-time high, about 14% of our total assets coming from equity. We also added close to about 2 lakh new folios in the last quarter. And overall, the SIP book has also shown improvement. It has moved from 816 crores as of June 2021 to 898 crores, coming from 32 lakh live SIP investors. With respect to alternate business, as there has been updates in the past that we have created a separate team of people to drive this business. In fact, our passive product offering grew by 6 times to 1,690 crores in June 2022. Our emphasis on building passive strategies also gained momentum by way of launch of more products through ETF, fund of funds, multiple index funds. Our existing passive bouquet has grown from 20 to 28 schemes. The another 20 schemes are on the pipeline to be launched this year. Our customer base in the alternate category, especially to the ETF, has grown to about 4,20,000 folios. With respect to the offshore business activities, we have received seed funding approval for Greater India ESG engagement fund that we launched. With this, we will take this product to the more number of investors in the global market and look at raising more money in this plan. With respect to the offering more products to NRIs and the gift receipt, also offering products to LRS investors, we have planned some launches in this area, subject of course regulatory clearances. On the real estate front, the first round of subscription to the Aditya Real Estate Fund, Credit Opportunities Fund, got closed this quarter, and we are evaluating multiple options both for offshore opportunity as well as onshore opportunity in the second launch. Moving to the financial number, our focus continues to remain achieving robust asset mix between equity and fixed income with high margin focus. We are maintaining our operating revenue and PBT even during the volatile quarter, as Vishal has mentioned. And during the Q1 FY23, despite market volatility during the quarter, our revenue from operations remains at 303 crores as compared to 5 crores the similar quarter of last year. And due to market volatility, the AMC treasury portfolio, which is an extra of 2,200 crores, has seen a mark-to-market impact, leading to a decline in other income compared to previous years. As a result of this, our overall profit after tax stood at 103 crores in Q1 FY23, while maintaining overall operating income close to the previous quarters. With this, I'll hand it over to Kamlesh for giving an update on BSLI performance.
Thank you, Birla, and good evening to all of you. After growing for the last 2 years at a healthy 30%, which was in line with the private industry growth, for the first quarter of this year, BSLI grew at 26% in the individual life insurance business and 193% in its group life insurance business, details of which are on slide 53. The good part about this growth is that it has been led by both productivity as well as the additional capacity that we created in the last quarter of last year. The total premium at 2,620 crores for Q1 has seen a healthy growth of 49% YOY with a two-year CAGR of 25%. The total premium growth is fueled by strong performance on renewals, where we collect 74% in value terms and close to about 88% in terms of NOPs digitally. And we have seen improvement in all cohorts of persistency, with 13-month persistency now at 85.3%. On slide number 57, tells the story about our new products. So our new product success continues, and it has contributed to 57% of our business in Q1. We've launched an interesting product in July, which actually will compete with bank fixed deposits space. And our new par product will help us complete the suite of our product portfolio. Our pre-approved sum assured, which we call PASA, the success of that continues with 14% business contribution in Q1. And our relatively younger customer profile has allowed us to get 28% of our Q1 business from upsell. Our group business grew at 193% in Q1, and this is on the back of a 74% CAGR for the last 2 years. And the AUM in this business is now at 16,000 crores. And in the profitable ULIP segment, we continue to be the second largest player. This year, we are looking at more than doubling our credit life business under the group business umbrella. On slide 58 gives you a picture of all our quality parameters, and we have done consistently well across all persistency in various buckets, be it 13th month, 25th month, or 61st month, along with well-managed OPEX to premium ratios. The firm now manages an overall AUM of 60,000 crores, and we've had a good year on our investment management, doing better than the respective benchmarks across our various funds. Our digital adoption across the various areas is visible in slide 60. 97% of our new business is sourced digitally, and practically all of them come with a auto-pay mandate for subsequent renewals. In line with our guidance given earlier, 57% of the sourcing is now auto-underwritten. 81% of all our services are now available digitally, and our self-service customer portal alone now contributes to 68% of our overall transactions. On slide 61 is the margin story. So we have managed to post positive net margin in the first quarter itself this year, and are at 2.5% net VNB margin. We closed last year at a net VNB margin at 15%, and with this healthy start that we have had this year, we are on course to deliver net VNB of closer to 18%, which will again be 1 year ahead of our previous guidance. And for the years ahead, we continue to maintain our guidance of doubling our absolute net VNB by financial year 25. With COVID claims now at subdued levels for 2 successive quarters, our claims are in line with plan. Please note that we continue carrying a COVID provision of 47 crores for the balance part of this year. To sum it up, our Q1 performance has been one of strong growth, with all our quality parameters doing better than last year. This momentum will help us grow this business in a value-accretive manner on both top line as well as improve profitability for subsequent quarters. So thank you, and with this I hand over to Mayank for the health insurance team.
Thanks, Kamlesh, and I'm happy to now present the performance of our health insurance business. We had a very strong performance in the quarter, enabled by the very strong foundation of a differentiated health first model we have set over the last 5 years that we have been in operation. The power of the proposition, which is more inclusive, but more importantly relevant and engaging, leveraging the very powerful tenet of consumers' health, has found a lot of acceptance by consumers and intermediaries both. We had in the last quarter of FY22 demonstrated the superior unit economics of our business model by bringing up one of the fastest quarterly break-even in the health insurance industry. Further, given the tailwinds for the category and all the enabling steps taken by the regulator and the government in the last few months, we had given a guidance that we will now be taking up a growth agenda and get the growth leadership back. that we've enjoyed over the last many years. We are pleased to inform that at 71% growth YOY in the last quarter, we were the fastest growing health insurance company in the country, well ahead of the industry growth at close to 21% and SAHI growth at 29%. This was of course powered by our retail franchise growing at a healthy 37% YOY. In addition, our corporate business grew at 168%, led by a huge focus on cross-sell and upsell and creation of a new category of offering corporate OPD, and these two together constituted 41% of our corporate business in the quarter. We believe we have set up one of the most profitable corporate business in health insurance in the industry. Overall, we acquired 3.7 million net new customers during the quarter, taking our overall customers served to 22 million, a 57% YOY growth. This has helped us take our SAHI market share to 12%, a 300 basis point increase YOY. On the profitability front, our combined ratio came down to 109% for the quarter, a large reduction from the 154% in the same period last year because of COVID issues. This brought down our quarterly loss to 71 crores from 128 crores in the same quarter last year. Higher scale will continue to create operating efficiencies as we move ahead, and we will continue to monitor our claims experience very closely. To take our differentiated model ahead, we continue to launch new range of offerings. Apart from corporate OPD, we also launched a one-of-its-kind retail OPD offering. Our flagship product, Active Health, which gives 100% premium back to customers for good health behavior, and it's one of its kind, not just in India but globally, continues to be a huge success and was rated the #1 product in health insurance by Forbes and CNBC. Our digitally enabled distribution mix is the most diversified distribution in the industry, with agency being the single largest channel at 22% of our retail business. We now have more than 68,000 advisors across 200 plus branches. We leveraged the One ABC branch strategy to nearly double our branch network at a low cost, and we are also synergizing with other BUs in areas like common advisors. We now work with 14 banks, having added IDFC First Bank and CUB Bank in the last quarter. On the digital front, our own digital business and the Digital Alliance Partners business together grew 130% YOY, becoming a sizable 16% of our total retail mix. We continue to invest extensively in our tech and digital capabilities with a clear focus on superior customer experience and scale hyper-personalized engagement given our health-first model. We continue to enhance our digital health and wellness ecosystem, which now has 60 plus partners and digitally available. And we are now working with multiple insurtech and health tech players to enhance customer value and operation efficiency. At 94%, we have the highest claim settlement ratio in the industry, a testament to our focus on key moments of truth for our consumers. Our digitally powered scale engagement helps us to know our consumers better with much wider access to consumer health and lifestyle data. We are using these through high-end analytics tools to create a much better business outcome across the life cycle, as outlined in slide 71. Looking ahead, we will continue to grow the franchise aggressively with a clear eye on best-in-class unit economics. We're now expecting to surpass our guidance of the 40% growth aspiration for the year as we gave at the beginning of this year, and this will be powered by a focus on getting more out of what we already have, fresh capacity creation both in agency and other channels, and also looking at exploring offerings a large pool of white spaces not yet addressed by the industry. Thank you, and I'll now pass it back to Vishakha for a closing remarks.
So once again, thank you all of you for joining us this evening, and we are very happy to take if there are any questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, good evening. So, Vishakha, particularly on the strategic side, when we look at it as far as the entire Aditya Birla Capital is concerned, so maybe in terms of the priorities out there and any strategic changes that you are looking at, or maybe what we are seeing in terms of retail plus SME, the targeted levels which are there within housing affordable that continues, or there would be any kind of changes which you are looking at the strategic level? And what would be your priorities at the business level, at the product level, at the team level, if you can highlight that?
Yeah. So, Kunal, as I said in my opening remarks, that if you look at the franchise, we virtually have all the products across, the customer segments, starting from a retail customer going up to the large corporate. The second thing I would say is that each of our businesses have now demonstrated that, the growth that we have seen is across our businesses. And I think that momentum will continue as we go forward. My belief is that in each of our businesses, we have building blocks in place, and I think they are in that inflection point. So as we see the momentum in the Indian economy that all of us are extremely excited about, we will see this growth reflected in our performance as well. Now, what is unique for Aditya Birla Capital, in my mind, is that the ownership of the customer. So we today have close to 39 million customers, as I said, which is a growth of almost 55% year on year. And we expect that growth of acquisition of the customer continue as we go forward. So we will work on our one ABC strategy, which means one customer, the one ABC branches, and so on and so forth, to actually cross-sell and upsell the products. We gave you the numbers as well, which are now reflecting, and we will only accelerate that, Kunal, as we go forward, which will contribute to our bottom line, as well as providing the complete solutions to our customer. The second thing that we will leverage, going forward, is also the entire ABG ecosystem, which of course we have done a modest beginning, but we will continue to leverage that, whether it means that the suppliers, the customers, the employees of the ABG, again, they could be our customers directly, and we have already started that journey. We will only accelerate as we go forward, which will also help us to add more customers to our, to our franchise, but we'll also have a profitable growth as we go forward. And of course, for doing all this, the technology and analytics will play an important role, in order to have the seamless journeys across products and customer segments.
Sure. And so this would be, even in terms of the priorities, if we have to set out, maybe from the medium-term perspective and the longer-term perspective, like these are the areas, these are maybe some of the gaps which you would want to fill at the entity level. What would that be?
So, Kunal, we'll continue to identify those gaps, but I think we have articulated our strategies in each of our businesses, so there is not much of a difference. Probably what we need to do is we have to continue to focus on the execution of that strategy. Just to give you an example, in case of an AFL, we have said that we will continue to utilize our book. If you see 64% of our today, the book is coming from the retail side of the business. We will, continue to focus on our SME, clients as well. We will continue to leverage our ecosystem within the group to acquire these customers profitably. And of course, we will be calibrated on our approach on the large clients. And, I think in each of the businesses, again, we have identified the specific focus areas, and we will continue to, work on those.
Okay. So broadly, maybe the existing strategy continues. The only thing will be some acceleration out there, much more focus on the execution and leveraging through the cross-sell and the upsell.
Yes, and the ABG ecosystem. You're right.
Sure. And one question for Rakesh in terms of when we look at the restructured pool. So in fact, that's down quite substantially on a quarter-on-quarter basis from almost 1,700 odd crores to 500 odd crores. So how has been the movement? It has been largely the repayments, prepayments. Have we seen any kind of a slippage because we are seeing some inch up in the retail and the SME side? So how has been the movement from this restructured pool?
So Kunal, we had total of 1,599 crores of restructured pool. Out of that, now only less than 500 crores is left, which is not open for repayment. Others have all opened up. And on whatever the accounts which has opened up, we have a 91% plus collection efficiency on that pool. So quite a decent performance of the restructured pool, Kunal.
Okay, so 1663 would be down to 1599 as such in terms of the principal post the principal repayments, and out of that 500 is something which is still under the moratorium, and on balance we are seeing like almost 91% of the collection efficiency.
Yes, Kunal.
Okay, got it. Yeah, thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Paras from Samco Asset Management. Please go ahead.
Hi, good evening. My question is around the digital ecosystem niche products in the NBFC. Are these
Paras, sorry to interrupt you. You're not audible. Can I request you to speak a little louder over the handset?
Yeah, so my questions are around the digital ecosystem niche products. Are these BNPL products, and what's the typical tenure of these loans? And what is the mix of various products in this category?
So we have different products for different ecosystem. We have BNPL, yes, for the consumer segment. We have checkout financing. We have merchant loans. We have lifestyle loans. So the entire range. We have healthcare financing. So we have an entire range of offering which we have, and not only BNPL.
Okay. And would you be able to provide the mix of these products in the niche category?
Yes, we can provide you that for different products. We have different tenors are there. So there will be a short-term loan for BNPL, but for education loan it might be 18 months to 24 months. For healthcare again 12 to 15 months. So different products have different tenors.
Okay. And what would be the percentage mix of these products?
I can share that with you. I will get you that numbers follow.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. Am I audible?
Yeah.
Sure. So just a few questions from my side. First to Kamlesh. If you can, give some color on your wallet share across some of the banking partners and how they have moved, more from a qualitative aspect. If you can, shed some light, and also the product mix across some of these partners. The second, on the margin front, the YOY increase that we see, is it just led by the mix change and maybe some amount of operating leverage, or has there been some amount of changes within the margins within the respective product categories also? Second, I think to Mayank, a few questions on the health insurance business. Since IRDAI has recently started publishing the retail renewal ratio number, so if you could give some color on that, even FY22 trends will work. Second, the customers who entered into the system around 2018 or 2017, the first customers into the ABH ecosystem, they have broadly completed 4 to 5 years now. So how do you see the claims in those cohorts versus the overall claims on the book, or let's say even compared to peers? And lastly, when I see your presentation, I see that there has been a strong uptick in origination through the digital ecosystem partners for ABH. So if you can, shed some color on the operational trends like persistency or claims ratio or price sensitivity for the customers in the digital ecosystem versus those originated through agents or let's say banking partners out there. So quite a few questions, but yeah, that's all from my side.
Dipanjan, Kamlesh here. Let me take your second question first. So on net margins that have gone up, yeah, I think it's a combination of more leverage that we are seeing in our proprietary business. So on the business composition front, more leverage there. That's partly the reason for net margins expanding. B, the mix obviously makes a difference on the net margin. So if you see the unit contribution would have been down as compared, we've done better than the plan. So obviously the composition of the products that we sell has a contribution on net margins. Some part of the fact that the interest rates have been higher as compared to what they were, some part of that contribution also comes into the net margin. So overall, it's a play that is there across some of these parameters that have helped us expand the net VNB margins, and that's what gives us the confidence that we will be able to deliver the net margins for the year, which should be again 1 year ahead of our guidance. On your question on composition that we have ties with about 8 banker partners. We've seen growth actually across the entire, and we operate actually in the public sector bank space, we operate in the small bank space, medium bank, and of course, we operate on HDFC, which is a large one. And we've seen across the board, we've seen growth rates coming in. In fact, some of the public sector banks that we have has grown by more than 100%. Some of the smaller ones that we have garnered scale right now, and they're growing at about 40-50%. And actually, HDFC Bank continues to give us a steady state growth year on year. So I think all of that has contributed to be on the partnership side. So I think these were the questions that you asked. Anything else before I give it to
Banker wallet share.
Sorry?
Banker wallet share.
The same thing I said.
Within HDFC.
Okay, anything else, Dipanjan? I'll hand it over to Mayank now to answer the question that you asked him, and then if you have anything else, you can come back.
No, Kamlesh, I think that's fine. Just one. So I think you mentioned 40-50% growth across the smaller banker partners, around 100% through the PSU banker partners. Is that correct?
Yes, Dipanjan.
Okay, and that will be for the quarter, right?
Yes, for the quarter, yeah.
Oh, okay, sure. Thanks, Kamlesh.
Thank you. Sorry.
On your question on claims, yes, we have cohorts of our business which have completed 3-4 years, and therefore the waiting period. The big statement is that our claims experience is broadly in line with what we price, and as you know, we always have the ability to reprice our product, which is allowed under the regulatory regime, and we continuously monitor that. About 1.5 years back, we priced one of our products to take care of the emerging claims ratio. The other thing is that some of the claims ratio today are, emerging because of, we are just coming out of the COVID period, and therefore to the extent that, the claims experience had COVID claims embedded in it, we'll have to watch for the next about 6 months and see how the post-COVID claims experience is fully playing out, as even the non-COVID claims, etc., start to emerge fully. Because as you know that, in COVID situations, some of the non-COVID claims get postponed. So we are keeping a close eye on how that trend is emerging. Sometimes, during COVID period, the non-COVID claims, cases, had gone up as we have had guided last year because of the additional, testing, etc., that tended to happen in those. So all of those are now starting to normalize, and we continue to watch that very closely. And as the industry has done in terms of looking at repricing wherever required, we always have that opportunity, and we are well positioned in terms of the price range that our products have to have that ability to do as and when we feel necessary. On the digital business, there are 2-3 kinds of partners we have. One is where the very regular offerings are sold through partners like Policybazaar and other such web aggregators, where our claims ratio are actually, again, fairly well, in line with what we expect. Typically, in health insurance, if you see the spread of claims, agency has, on the slightly higher, and then you see, such partners like Policybazaar and then banks. And the obvious reason is because of the way the customer selection is done. The best selection tends to happen in the banks, where the customers much better than let's say in an agency environment. Costs, all of that are also accordingly spread, where you have the lowest cost, as you spread out of initial fixed cost in agency. So I think though, each channel has its own kind of profitability signature. There are other set of digital partners which are selling what I call the non-traditional, bite-sized, contextual, in the context of the journey happening on their platform products, where again we have had very, very good experience of claims, well within what we expect. In fact, in some cases, better, in which cases what we tend to do is to go back and make the product more kind of meaningful for the consumers by passing on some of the benefits in the way we reprice the products. Renewal ratios, yes, over a period of time, we have seen that the traditional channels which have been in the business for long, like agency, which really, because health is a more high engagement business, you need the distributor to go and resell the product in the year 2 and year 3. Typically, you see a bit of a fall in your 13-month persistency and then picks up very rapidly in the 25th and 37th month, because once the consumer has paid for 2 years, they tend to stay with that product. We've seen similar experience in our case in channels like agency. Banks are now kind of finding the whole process to become more mature, because they have started selling health insurance more recently, and the engagement model is also now starting to emerge in terms of the way both the manufacturer and the banks tend to work. And as we have seen in the experience of life, where as they start making the process more mature based on their experience, that's happening in the banks also, where they're now starting to catch up with the traditional channels like agency. So overall, I think the experience is good and in line with what we see in the industry. Thank you.
Sure, man. For the detailed clarification, and all the best to the overall team.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, good evening, everyone. Thank you very much for the opportunity. So the first question is with regards to the credit card partnership, which we have, the co-branded card with SBI cards. The two questions there. One, how is the data sharing arrangement with SBI cards, and who will own the customer? What kind of value do we see here if SBI cards is going to own the customer there? Secondly, as per the recent directives, RBI seems to be becoming more open to giving credit card licenses to NBFCs. So why not? Are we exploring opportunity to issue a card going solo? Is that something on the cards as well?
So yes, we have started. We have been working on this for the last 7-8 months with RBI, with SBI in terms of co-branded card, and which that is the one which we have launched. Yes, we are evaluating post the regulation which has come from RBI. We are evaluating in terms of can we do it ourselves, and we are in discussion with RBI in terms of our application for approval. In terms of SBI co-branded, we are looking at distributing it to our customers within ADFL, within Aditya Birla Capital customer base, and also extending it to Aditya Birla Group ecosystem. So that's how we are looking at, and also we will look at in terms of open market sourcing for this card as well. So we are looking at this step by step. So we have already launched it internally to our Aditya Birla Capital ecosystem, and we will extend it further to the group as well.
Okay, so on this, just to extend it, so we will just be getting a sourcing fee, and SBI cards will have access to all the data on the customers. Is that correct?
These are our customers. We will have all the data of these customers, and once the credit history is built on these customers, we will have the ability to cross-sell any other lending product or insurance product from the Aditya Birla Capital. So we will be able to cross-sell to these customers, and these are our customers as well.
Okay, got it. And second thing is with regards to the capital requirements, like we have already outlined our growth for FY25, and we are doing very well on the targets. When I look at the next 5 years, some of the businesses might need more capital, including the insurance and the fast-growing health business. So what kind of capital requirements do we see there, and are we confident of generating it through the internal cash flows, or will we be depending upon some kind of issuance? Will we need to depend on the market for that? Thanks.
So at the moment, actually, we did our capital assessment, and our view is that all our businesses are well capitalized. As you know, we recently have infused some capital in both our life and health companies. As we go forward, we will keep calibrating, the opportunities in the market and the capital requirements, and of course, we will evaluate all the sources which are available to us in order to raise that capital. But looking at our brand, looking at our positioning, looking at, the parentage that we have, I don't see an issue in raising capital. It's, for all our businesses.
Okay. And is there a timeline around that, Vishakha, given the targets you have set? Is it going to be a 2-year kind of timeline or maybe a longer period timeline, like 2 to 5 year time frame as per the growth outlook that you have?
So, looking at the today's opportunities as we see it, I think all our businesses we believe that they are capitalized for the next 3 years growth. But as I said, we'll have to keep calibrating the opportunities in the market, our own positioning, how we want to leverage those opportunities, and we will not starve our businesses for the want of capital. That much I can say, and you'll agree with me that that capital therefore will not be a constraint because of the reasons that I articulated.
Okay.
But at the moment, they've looked at a 3-year horizon. Yeah.
Okay. Got it. Thank you very much for that.
Yeah.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good evening, everyone. Sir, firstly to Mayank, I couldn't, get the claims ratio. If I don't know if it is disclosed in your investor presentation, if you could just give out that number first. And secondly was on the life insurance business. So given the kind of increase in the non-par business which we are seeing, so is there some repricing which you have done after the increase in the interest rates across banks and three rates? So, yeah.
Sorry, what was the first question? I didn't get.
Sorry, can you repeat the question? We couldn't hear it properly.
So, so my first question was on the insurance business. If you would give out a split of your combined ratio in terms of your claims and OPEX ratio.
Yeah, so on the combined ratio, out of 109%, it's about close to 55% claims and 54% expenses.
Got it. And what's our target for the full year? I mean, in terms of combined ratio for the health business?
This is something that we continue to monitor because, there's so much of growth tailwind that we have in the business that we'd like to participate, and given our growth leadership, I think, and especially now that the regulator is also opening up so many more opportunities. So I think that will depend on what stand we take on the new opportunities that come up. But as I said earlier, we keep a very close eye on the unit economics of everything and every new business or every new opportunity that we pick up, as we had demonstrated in the last quarter when we demonstrated our break-even. So that's the overall focus we keep in the way we run the business.
But do we think we are on the target to achieve 100% combined by Q4 FY23?
We had given the guidance last year that what was important for us to demonstrate is that our business model is unique, and unit economics is much more superior than what you observe in a business where typically companies have taken 7-8 years to break even, and we demonstrated as much ahead of time. Now that we have demonstrated at a unit economics level, we would like to fully participate in the growth opportunity, because if you're writing on its at a unit level profitable business, we will not like to leave a growth opportunity on the table, and that's the growth mandate that even Vishakha was referring to earlier. And with all the tables, I think it makes sense for the franchise to continue to build on this business, because the rate at which the new consumers are also getting added can actually be very value accretive to overall franchise as well.
Got it. And on the life insurance?
Yeah. So I got your question. You asked about the non-par business. Let me try and answer that. So basically what we do is we try and focus on the mix of what we sell, and it has to be relevant for the point in time. So two questions you asked about the mix that we have as a non-par is higher. I think higher interest rate scenario in the market provides an opportunity at the point in time to see whether you can place some of these products with your customers. Similarly, also because the protection prices are significantly higher at this point in time, and the associated risk with that is not fully evident because we just moved out of COVID. We basically are playing low ball on that, and as and when we want to get back to the trajectory, obviously we'll get back to protection. From a risk point of view, we follow a clear strategy to say that 100% of our expected maturity benefits are fully hedged, and therefore we have a strategy which keeps looking at that at different points in time. Like I said, we've launched a very new innovative product which will compete with the bank fixed deposits that is also on a guarantee non-participating platform. And some part of the mix we'd like to make sure we get through the year because we are launching another product on par, which will complete our product suite. So it's a function of what we want to do at that point in time. So there's an opportunity, like I said, because of high interest rates, we place those products, and from a risk point of view, they are fully hedged. 100% of our expected maturity benefits are fully hedged.
Have we repriced any of our non-par products? Have you increased IRRs on any of the products?
So when we look at our various products with rates changing at different points in time, life insurance companies are allowed to reprice their products to what they call minor modifications. And yes, in some of our flagship products, one or two of them, yes, we have repriced some of these products with interest rates moving up as offerings to customers.
Got it. Thanks. Thanks for that.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Alpesh from IIFL Securities. Please go ahead.
Hey, hi, good evening, and congrats on the good set of numbers. Just 2-3 questions. First is on the housing finance business, we are running higher than the guided range of margins and the ROAs. And what I understand from our comments that as the growth will pick up, the operating leverage will also play out. So would you like to revise the guidance on that front? That's the first part. Secondly, on the NBFC business, looking at the current state of the portfolio, including the COVID-related portfolio which is coming out of the moratorium, etc., would you like to offer some guidance on the credit cost side?
So the first question was on the housing in terms of revising our guidance. I think if you look at on the profitability metrics, we have delivered what we had guided for. We are looking at getting to the growth metrics on the balance sheet, and that's what the focus right now is. We will continue to focus on the affordable segment with a focus on growth. And if there is a need at the end of this financial year, we will relook at our the guidance. Yeah. On the
Sorry to interrupt you on this, but in case you are going to grow on the affordable as the incremental mix is going to be higher on the affordable housing side, where do you see the margin compression coming up for you? In the sense for you to have a ROA of 1.5, 1.6% versus currently at 1.9%, the only metric that I can think of would be the margins, right? Since the credit cost has come more or less on a steady state basis now.
So if you look at our cost income ratio, because we have invested for growth, and that will start delivering. So we have increased our capacity, we have enhanced our branch footprint, and all this will start delivering in terms of growth. So as we get out of growth, all the investment which we have done on the cost side, that will start, I think you will see efficiency there. And that should help us improving or maintaining the ROA, ROEs which you are talking about. So clearly our focus is...
So clear, in case the operating leverage is going to play out and your current ROAs are 1.9 versus the guided range of 1.5, 1.6. So the only metric that I can think of would be some compression onto the margins as the growth will pick up. So is the understanding right?
So margins, yes, if we start looking at the growth, there will be some segments which we were not focusing on and we start getting into those segments. You will see, but we want to really keep the margin in the same range, some basis point here and there. To keep the margins, we want the cost to really start. We want to leverage all the investments which we have done on the cost front. So that's how we look at it. Yes, we want to maintain we are not guiding that the ROA will come down with the increase in the growth. We want to maintain the guidance on the current ROAs which we have, but our focus will be on growth going forward.
And which are the products that where you are not focusing and you would like to focus within the housing finance segment right now?
So, see, some bit of prime housing which we can do. Some bit of construction finance right now is a very, very small portfolio, so we want to look into that. Also, the distribution which we have built from a 62 branches last year to now 121, and our plan is to go to 200. That will help us to increase and improve our sourcing as well, and that should help us book growth. So all of this combined should help us maintain the profitability.
Okay, got it. And on the NBFC side, the credit cost, any guidance on that front?
No, so long-term guidance, we have been giving this. I think we will, if you see last quarter, it was 1.13 was our credit cost. We will stay in this range as of now because a lot of retail growth is coming through. Yes, the credit cost will come down on the corporate side, but as we grow the retail segment, it will range in this 1.2 is what the guidance which we had given or we had discussed earlier, and we will stay in that range.
So even in case of NBFC business, you don't see any risk for the ROAs coming down from the current levels of 2.5%. If at all, there would be some improvement with the operating leverage scaling out.
Yes, so we are looking at improving that. No, the ROAs won't come down.
Okay, great. Just last question on the life insurance segment. Since the protection, we have been guiding for around 12 to 15% kind of a mix, but currently we are at around 3 to 4% kind of a protection mix, and there are some issues at the industry level as well. So, any guidance that you would like to offer, and when we are giving a net VNB margin guidance of around 18%, what kind of a protection mix are we factoring into that?
No, so the guidance of 18% at this point in time doesn't have any indication of the protection business going up significantly from where we are. And the reason for that, like I said, is there is a significantly high pricing built in this. So it will look like a high margin product, but today the reinsurance pricing in this business is significantly different from what it used to be. And therefore, risk adjusted and reinsurance adjusted, is it as exciting as it used to look 1 year back? The answer to that is definitely no. Like I said, as and when, because we are in a post-COVID scenario, we are seeing prices, even from a reinsurance point of view, moderate, say, in the group term insurance business now, not yet in the individual life insurance business. And previously, when we used to be at 6% and we wanted to take that number to 10, we were able to actually do that in about 90 to 120 days in the first quarter of last year. So at this point of time, two things that you asked, whether we think protection business will go up from here, it will be range bound at about 4.5%, and our guidance of 80% is not dependent on protection business going up significantly through the year. But if there is an opportunity and prices moderate, and it becomes an interesting product both from risk, like I said, and adjusted for the insurance price, we'll step up the accelerator on that through in the second half of the last quarter of this year.
Okay, and just one final question on the life insurance. On the CLI business, in the group life insurance segment, do you expect the mix to remain the same, or the mix is likely to change in favor of any particular product?
You're talking about the credit life insurance business, right?
Credit life insurance, yeah.
Yeah, no. I mean, we are present across the various segments, be it microfinance, be it housing, be it personal loans. And like we created some products which has given us an uptake, and in our endeavor to grow that business, like I said, more than double, the composition of mix is not changing significantly.
And are there any profit pressures into that business or the competitive pressures coming up, considering protection is having some issues right now?
You're talking about credit life business again?
Credit life insurance business again, yeah. From a competitive
I mean, like I said, the repricing that happened across the group term insurance business, credit life and individual life insurance. We are seeing that pressure easing out on the group OIT and credit life to some extent. There is no, I mean, it's more a question of the opportunity and the products that we have which actually compete in the market slightly better. And we have the advantage of being able to file that product and get an approval. So that's what is helping us get higher momentum on the credit life insurance side.
Great. Thank you and all the best.
Thank you. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Thank you. Just had one question for Rakesh. If I look at the NPAs across NBFC and HFCs, they have marginally inched up sequentially. And just wanted to check whether that was only due to slippage from the restructured book or there is more to it.
No, so Rikin, yes, there is some slippage from the restructured book, and which we are looking at resolving in quarter two, especially coming from the SME segment. So I think overall numbers, and if you look at from a provision cover also, and also stage 2 has come down for us, so collection efficiency is looking quite good. So it's just that the restructured portfolio has slipped forward. Otherwise, I think portfolio is looking in good shape.
And would you be able to quantify the slippage from the opening restructured book in this quarter? And did I hear correctly that the slippage has mainly been the SME segment?
Yes, SME and the retail segment, these are the two segments, the small ticket loans. So there is primarily the slippages there.
And the amount of slippage from the opening restructured in this quarter?
I can just share that with you, Rikin, offline. I don't have it readily available.
No worries. Thank you very much.
Thank you very much. Ladies and gentlemen, due to time constraint, that will be the last question. I now hand the conference over to Ms. Vishakha Mulye for closing comments.
No, so again, thank you very much for joining us this evening for our call, and we look forward to keeping in touch. Thank you so much.
Thank you very much. On behalf of Aditya Birla Capital Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.